Preparing for a financial analyst at Duke Energy interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a financial analyst at Duke Energy? Duke Energy appeals to me because its financial decisions affect essential infrastructure, customers, and the transition to cleaner energy. I am interested in analyzing operating performance, capital projects, regulatory outcomes, and funding needs rather than evaluating purely short-term market movements. The role also combines rigorous modeling with business partnership. I would bring strong Excel, accounting, and communication skills while learning the utility industry and helping leaders make decisions that balance reliability, affordability, returns, and long-term sustainability. While answering, focus on Duke Energy's essential service business, regulated utility economics, clean energy investment, analytical development, and how your skills can support reliable operations and disciplined capital allocation. Question 2. How do the three financial statements connect? The income statement explains profitability, the balance sheet shows the company's financial position, and the cash flow statement explains changes in cash. Net income flows into retained earnings and starts the operating cash flow calculation. Capital expenditures reduce cash while increasing property, plant, and equipment. Depreciation later lowers earnings and asset balances without using current cash. I always reconcile the statements because inconsistencies often reveal modeling errors, timing issues, or misunderstood accounting assumptions. Make sure to cover net income flowing into retained earnings and operating cash flow, balance sheet changes affecting cash, capital expenditures increasing assets, and the importance of reconciliation across statements. Question 3. What is unique about financial analysis for a regulated electric utility? A regulated utility operates within a framework where regulators generally determine customer rates and the costs that can be recovered. Financial analysis therefore links operating performance with rate-based growth, allowed returns, regulatory timing, and customer affordability. A project may be strategically valuable even if its near-term earnings contribution is limited, provided recovery is reasonably supported. I would analyze both financial results and regulatory milestones, because regulatory lag or disallowances can materially change cash flow and returns. In your answer, discuss rate regulation, approved cost recovery, allowed returns, rate base, service reliability, regulatory lag, and why operational and regulatory assumptions matter alongside conventional financial metrics. Question 4. How would you build a monthly forecast for Duke Energy? I would begin with historical actuals and identify the operational drivers behind revenue, fuel, purchased power, payroll, maintenance, and other expenses. For a utility, I would explicitly model weather, demand, fuel prices, generation mix, planned outages, regulatory items, and capital spending. I would obtain assumptions from operating teams, document them, and build monthly phasing rather than relying only on annual averages. Finally, I would compare forecast against actuals, investigate variances, and update assumptions transparently. Be sure to mention historical actuals, volume and price drivers, weather, fuel costs, operating expenses, capital spending, headcount, regulatory assumptions, stakeholder input, and variance-based forecast updates. Question 5. What operating metrics would you monitor at Duke Energy? I would monitor metrics that connect operations to financial outcomes. These include electricity demand, weather-normalized sales, customer growth, generation availability, outage frequency and duration, fuel and purchased power costs, O&M per customer, capital expenditures, operating cash flow, and regulatory milestones. I would avoid viewing any metric in isolation. For example, higher generation costs may reflect fuel prices, plant availability, or customer demand. The strongest analysis explains the operational cause, financial effect, and management response. Focus on customer demand, weather-normalized sales, reliability, generation availability, outage frequency, fuel costs, O&M per customer, capital spending, cash flow, and regulatory performance. Question 6. How would rising interest rates affect Duke Energy? Higher interest rates can increase borrowing costs, reduce the present value of long-lived assets, and make new capital projects less attractive. They may also pressure customer affordability if financing costs ultimately enter rate proceedings. I would examine the maturity schedule, variable rate exposure, refinancing requirements, interest coverage, and the effect on capital project returns. Management could mitigate pressure through liquidity planning, staggered maturities, fixed-rate financing, disciplined investment pacing, and close coordination with regulatory recovery timelines. Discuss higher debt service costs, refinancing risk, valuation pressure, required returns, project economics, customer rate implications, and possible mitigation through maturity management, liquidity, and financing mix. Question 7. How do capital expenditures affect a utility's financial statements? When Duke Energy spends on a qualifying plant or infrastructure project, cash decreases and property, plant, and equipment increases. Depreciation begins when the asset is placed in service, reducing earnings over its useful life but not creating a new cash outflow. Financing the project affects debt, interest expense, and cash flows. In a regulated context, the project may also enter rate base, subject to approval and prudence review, linking accounting treatment to future customer recovery. Cover initial cash outflow, capitalization in property, plant, and equipment, future depreciation, financing effects, rate-based treatment, cash flow timing, and the distinction between capital and operating expenditures. Question 8. How would you evaluate a proposed renewable energy project? I would evaluate the project's full economics, beginning with construction cost, expected generation, capacity factor, operating expenses, useful life, tax benefits, interconnection costs, and financing assumptions. I would calculate NPV, IRR, payback, and sensitivity to power prices, delays, curtailment, and cost overruns. I would also assess regulatory recovery, reliability value, permitting, supply chain exposure, and emissions objectives. A project can create value beyond standalone returns, but those strategic benefits should be quantified where possible and clearly separated from financial assumptions. Mention construction cost, operating savings, generation profile, capacity factor, tax incentives, interconnection, regulatory recovery, financing, risks, NPV, IRR, and reliability or strategic benefits. Question 9. What is regulatory lag, and why does it matter? Regulatory lag is the period between when a utility incurs an investment or expense and when approved customer rates reflect that cost. During the lag, cash flow and earned returns may be pressured even if the investment is ultimately recoverable. I would model the timing of construction, filing, approval, and rate implementation, then assess whether riders, interim rates, or other mechanisms reduce exposure. Understanding lag is essential for forecasting earnings, liquidity, and funding requirements. Explain the time between incurring costs and receiving rate recovery, its effect on cash flow and earnings, causes such as construction timing, and possible mitigation through filings or mechanisms. Question 10. Walk me through how you would analyze a budget variance. I would first quantify the variance and assess materiality, then decompose it into volume, price, mix, timing, productivity, and one-time effects. For example, an unfavorable generation expense variance could reflect higher fuel prices, increased demand, an outage, or accounting timing. I would validate the explanation with the operating owner, determine whether the issue is controllable, and assess the full-year impact. My communication would distinguish what happened, why it happened, and what action or forecast change is required. Be sure to cover materiality, actual versus budget comparison, price volume mix and timing drivers, one-time items, controllability, business owner discussions, forecast impact, and clear communication. Question 11. How would you build a sensitivity analysis for a utility forecast? I would identify the assumptions with the greatest uncertainty and financial sensitivity, such as demand, weather, fuel prices, project costs, interest rates, construction timing, and regulatory recovery. I would establish a realistic base case, then create downside and upside cases using documented assumptions. I would test individual drivers and combine scenarios because risks can compound. The output should show effects on earnings, cash flow, leverage, and project returns, along with the decisions or contingency actions each scenario supports. Discuss selecting key uncertain drivers, establishing base and downside cases, changing one variable at a time and in combinations, measuring earnings and cash impacts, and presenting decision-relevant conclusions. Question 12. What is the difference between EBITDA, EBIT, and operating cash flow? EBITDA is earnings before interest, taxes, depreciation, and amortization. EBIT includes depreciation and amortization. Operating cash flow starts with net income and adjusts for non-cash items and working capital changes. EBITDA can help compare operating performance, while EBIT reflects asset consumption more realistically. Operating cash flow captures cash timing but excludes capital expenditures. For Duke Energy, I would not treat EBITDA as free cash flow because substantial capital investment, interest, taxes, and working capital requirements remain. Explain each metric, depreciation and amortization treatment, working capital effects, capital expenditures, usefulness and limitations, and why cash generation cannot be inferred from EBITDA alone. Question 13. How would you assess Duke Energy's liquidity and leverage? I would review cash and committed revolver capacity, operating cash flow, debt maturities, interest coverage, debt to capital, credit ratings, and expected capital spending. I would also incorporate dividends, regulatory timing, seasonal cash needs, and potential project overruns. A strong assessment looks forward rather than relying only on year-end ratios. I would run stress cases for weaker demand, higher rates, delayed recovery, or construction inflation, then compare available liquidity with the company's obligations and financing access. Focus on cash balances, revolver availability, operating cash flow, debt maturities, interest coverage, debt to capital, credit ratings, capital spending, dividend commitments, and stress case liquidity needs. Question 14. How would you analyze the effect of weather on utility results? Weather affects electricity demand through heating and cooling needs, so I would compare actual heating and cooling degree days with normal levels by service territory. I would estimate the effect on customer usage, generation, fuel consumption, purchased power, and revenue, while considering rate structures and hedging. I would separate temporary weather noise from underlying customer growth or efficiency trends. The forecast should show both reported results and weather-normalized performance so management can judge sustainable operating momentum. Mention heating and cooling degree days, customer demand, weather normalization, regional differences, revenue and cost effects, hedging, and separating temporary weather impacts from underlying trends. Question 15. What is free cash flow, and how would you use it at Duke Energy? Free cash flow is generally operating cash flow less capital expenditures, although companies may define it differently. At Duke Energy, I would use it to assess internally generated funding for infrastructure investment, dividends, debt reduction, and other obligations. A negative figure is not automatically concerning if it reflects productive, recoverable growth investment, but I would examine funding needs, regulatory timing, and project returns. I would also distinguish recurring free cash flow from temporary working capital or storm-related movements. Define operating cash flow less capital expenditures, discuss interpretation during heavy investment cycles, debt and dividend funding, regulatory timing, and why recurring versus project-related cash flow matters. Question 16. Tell me about a time you found an error in a financial model. In a budgeting exercise, I noticed that a depreciation schedule was using the full-year expense for assets placed in service midway through the year. I traced the issue to a missing commissioning date formula, corrected the monthly convention, and quantified the impact on earnings and cash forecasts. I explained the issue promptly, documented the fix, and added a date-based check to the model. The experience reinforced that review checks and transparent communication matter as much as technical modeling ability. In your answer, use a specific situation, explain the control or review step, quantify the potential impact, describe how you communicated it, and show the preventive improvement you implemented. Question 17. How do you ensure accuracy when working with large datasets? I start by confirming the source, reporting period, definitions, and expected units. I preserve raw data, use controlled transformations, and create checks for missing records, duplicates, unusual movements, and totals that should reconcile to the general ledger or reporting system. I test a sample back to source and document assumptions, formulas, and version changes. Before distribution, I review the outputs from a decision-maker's perspective and ask whether the results are economically plausible, not merely mathematically complete. Cover source validation, data definitions, controlled transformations, reconciliations, exception checks, version control, documentation, sample testing, and independent review before distributing results. Question 18. How would you explain a complex financial result to a non-finance manager? I would lead with the conclusion in business language, then explain the operational drivers using a short bridge. For example, instead of saying margin declined because of unfavorable variance classifications, I would say higher fuel costs and an outage reduced results by a specific amount, partly offset by stronger demand. I would separate actual facts from estimates, avoid unnecessary jargon, and finish with the forecast implication and any action needed from the manager. Clarity should support a decision. Focus on starting with the conclusion, translating accounting into operational drivers, using a simple bridge or example, separating facts from assumptions, and ending with implications and requested actions. Question 19. How would you prioritize competing requests from senior stakeholders? I would clarify the decision each request supports, its deadline, materiality, and dependencies. Regulatory filings, executive commitments, and items affecting safety, liquidity, or external reporting would generally take priority over routine analysis. I would estimate effort, identify reusable work, and communicate trade-offs early rather than silently missing expectations. If priorities conflict, I would present a concise plan to my manager and stakeholders, agree on sequencing, and provide progress updates with clear risks and revised timing. Mention urgency, decision impact, regulatory or reporting deadlines, effort, dependencies, stakeholder alignment, transparent trade-offs, and proactive status updates when priorities change. Question 20. What would you do if an operating partner challenged your unfavorable forecast? I would first listen carefully to understand which assumption they believe is wrong, then review the source data and operating context with them. I would test alternative scenarios rather than defending my model automatically. If I found an error, I would correct it and explain the impact. If the disagreement reflected judgment, I would show both cases and the supporting evidence. The goal is not to win an argument, but to produce a transparent forecast that leadership can trust and challenge appropriately. Be sure to mention listening first, validating assumptions and data, separating disagreement from error, testing alternatives, maintaining independence, and reaching a documented, evidence-based conclusion. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.